We all know the term YOLO, right? Even if you're like the least hip person out there. YOLO, you only live once. You hear the song right now playing? Well, that's made popular by Drake. Of course, he didn't really come out with it, but he popularized it in 2011 with an album. So you only live once, which is kind of intriguing, right? Because essentially when we get news, right, and it's really bad, Americans tend to just kind of throw their hands in the air and say, you know what the heck? I can spend my time doing nothing and do just live as well as other people. So this is what my next guest is talking about the idea of YOLO and how it can create great memories, but may not be the best way to trade the market. I want to bring in marketgauge Managing Director Michelle Snyder. All right, Michelle, these YOLO periods, really, let's talk about how they really have altered the economy and the stock market, because I think it's given the experts a lot of fits.
Absolutely. And it was such a great introduction, because this really came to my mind in the airport over the weekend when I spoke to the guy who was pushing my mother's wheelchair to the plane. And he said, oh, my God, it's going to be insane next week. People are just out figuring you only live once. And I thought, wow, this is, a guy working in an airport. So it really is reflecting why something like the retail sector, which we can look at XRT, my good old granny retail, really stopped the bleed a couple of weeks ago in the Russell 2000 and the small caps when things started to look dire. And with the rally that we've seen this week, and of course the correction we're having today, now we have to wonder whether or not we can get through this most recent negative news that we've had with Walmart and slowing manufacturing, et cetera, and then get back to a higher seasonality through the retail.
I think this has really caught a lot of economists and market experts off guard all year long, to be quite frank with you. And I think the source of it was all that money that cascaded into the economy. A lot of it, I think, unnecessary. So the question is, are we going from YOLO to oh no, right? Oh no, we've got to pay a price for it. To your point, ideally, the script says the market should be up today because bond yields have gone down a lot more, even a 10-year. We were up. We're giving that up. So something is still spooking this market.
Well, actually, we don't really want the yields to go down that much more. We want the yields to stay sort of in line with the rate of inflation, and we're kind of there right now. With the Fed actually basing everything on their monetary policy in terms of interest rates, of course, that could be the next shoe that drops next year if they decide to lower the rates more because they're worried about recession. But right now, it seems to me that if things stay exactly where they are and we don't have any major disasters erupt in the next couple of months, we could actually, we just went from 160 to 180 basically in the Russell 2000. That's a hell of a move in a couple of weeks. And we've been in a 160 to 200 range in IWM for over a year. So we're mid-range right here, which tells you you're going to know very, very soon if we can get through that 180 level, that 1800, which I know we've talked about many times, then once again we'll be looking back at the top of the range. Michelle,
with that in mind, I just want to show the audience, though, because the Russell 2000 has been where everyone's making the big bets. It's hard to see it here, but I'm going to show you. You don't really have to be an expert to see that this is normally where your volume is, right, on these calls. We're like 200 or 300% higher than we normally are. You just talked about the moves that it's made. It's made some pretty good moves, but I still think Wall Street is betting on it to go higher. My question is, does this kind of overwhelming bet become a contrarian indicator? Does it make it actually harder for the Russell to go up?
Well, that's very possible. I mean, we'll just look at the last several years. The Russells have underperformed, particularly if you're looking at growth stocks, for so long now. I think the bet is based on the fact that people are just exhausted with the notion of everything is about growth stocks, and people feel at some point the economy will grow. But that could wind up being a little bit premature. I really don't see that happening maybe until about 2025.
All right, so you had an interesting comment on your note about the growth stocks and the Qs, right? I think you said something like that you would prefer to see consolidation, maybe even a correction. So, I mean, we're getting towards some resistance point, maybe near a double top here. Listen, the relative strength suggests maybe it's overbought near term, but you don't want this to come down too much. Do you want to see it go through the 200-day moving average of 50, or do you want to see it hold there as a test?
In terms of the NASDAQ, right now, it's at the top of the range that we saw in July. So some level of consolidation at these levels would be healthy. I actually believe at this point, again, we have to go back to the Russells. If they can hang in the game here, that will drive Qs to new highs. That's what it looks like to me right now. If the IWM starts to collapse, that will exhaust the people that are really heavily long in the growth stocks up at these nosebleed levels.
By the way, Michelle, I've got some of your ideas some of the stock picks you wanted to share with the audience. Coin, which has been on fire, Floor, and Bumble, which is interesting. I remember a couple years ago they told everyone to take a week off. I knew that wasn't the stock for me. I think management has sort of become more business-oriented since then. It's so great having you on, Michelle. Thank you so much.
Thank you, Charles.